Our next guest says bifurcation in the mega cap trade is set to continue. Let's bring in Ankur Crawford, Executive Vice President and Portfolio Manager at Alger, with me here at Post 9. It's nice to see you again. This bifurcation you're talking about, it's bye-bye Mag 7, hello Mag 4.
Yes, hello Mag 4. And, you know, there's some that occasionally become unmagnificent, and that's what we're kind of seeing right now with Apple, Google, and Tesla.
I mean, sending Apple, Amazon, well, Amazon's in. Apple, Google, and Tesla, they're go to the curb?
Well, just for now.
Apple?
Yeah, you know, so here's the thing with Apple. Apple has great prospects, but they just have to deliver. And oftentimes, Apple is a late bloomer. So they weren't necessarily the first ones to a large screen phone. They weren't the first ones to think about like a phone without a keyboard. So it's okay for Apple to be a kind of a fast follower, and I think that's what they will be for the consumer. It's just not now. I would say Vision Pro is okay. It's not fantastic.
But in the past, because of everything you said, they're not first mover, they're usually best mover. We give them the benefit of the doubt. That's why the stock usually runs up ahead of earnings and things like that. What's wrong with this time? Why isn't the stock getting the benefit of the doubt when it comes to AI?
Well, I think given the multiple, it is being given the benefit of the doubt to some extent, right? Because the multiple is not reflective of the growth. So
the multiple's too high, the growth is too low.
That's right. And I would argue Meta is more compelling than Apple today in terms of the growth and the valuation relative to Apple. So I think it's more about the opportunity cost. If you have to put $1 into something today, do you want the lower growth, higher multiple or the higher growth, lower multiple? And you'd always choose a higher growth, lower multiple.
Okay, so for somebody who owns many of these large tech stocks, are you concerned about the underperformance, let's just say over the last month, as other sectors have done much better?
The underperformance of Apple?
Of tech.
Oh.
Right, as a group. I mean, tech is the sixth best sector over the past month, behind discretionary, industrials, materials, financials, and healthcare. Is that something that's just getting started?
Maybe. However, I think even inside of tech, there's a big bifurcation. So security and software is doing really well. Semis are on fire. And then there's other parts of tech, like the IT services companies, that are doing poorly. So even inside of tech, you're getting a bifurcation of winners and losers. So I think it's hard to put a broad swath and say all of tech is doing poorly. You know, Nvidia is doing fantastic.
Well, it's obviously not. Yes, of course. Well put. I mean, it's not all obviously doing poorly, but there is some thought in the market that it is primed for a breather. Maybe Nvidia included. I mean, it just can't keep going, you know, up to the moon every day.
Would be nice.
Theoretically. Well, it has been. Come on, don't be greedy. But that it's going to take a breather, and that some of these other stocks are actually going to have even more legs than they've shown recently.
Yeah, and you know what? I think in all fairness, that probably has to happen, and in part because if you look at the valuation discrepancies in other sectors today, they are widening. And usually when we see that, we either have a catch-up trade of things that lagged, or we get a normalization of everything that worked. And at this point, given where the economy is and the strength in the economy, where interest rates are, I think we more have a catch-up trade of the rest.
When you look at Google, or Alphabet, I guess.
You call it whatever you want.
I'll call it that. I will tell you that it trades at a discount to the market right now.
What's its forward? It's 24.
18,
no, it's forward. It doesn't trade at a discount. It still trades at a premium.
Slight.
It's at like 19 times. It's like 19 times.
Yes.
If you believe the numbers. Because they haven't been able to deliver on the numbers.
Their healthy fundamentals have been overshadowed by management missteps.
I'll come to you in a sec, Josh. Hang on.
I think there's concerns about reliability in their AI models. You type some things in, and you know some unexpected things come out. I would call that a management misstep, right? So you've seen a little bit of backup. There's long-term concerns about the moat around their cloud computing business, but and lack of progress on operational efficiency. but it is one of the best positioned companies to capitalize on AI if they get their house in order. And you could take me back well over a year ago when we were saying some of the same negative things about Meta, okay? And they got their house in order. Meta cut 22% of their workforce. Over the last year, Google cut 4%. There's room there. I'm telling you, there's operational leverage in that business, and I'm comfortable being overweight that in our growth portfolio.
Okay, Josh, you wanted to say?
I fully agree with what Rob is saying on Alphabet, and the parallels to Meta should not be lost on the audience. Meta looked like it was finished at the low. The low was like Jimmy Cramer after the earnings on the air, like basically apologizing for being bullish on it. But the bulls were right. Jim was ultimately right. And, you know, Meta was in that place for a variety of reasons. And it's different reasons why Alphabet's there. They have not done as much as Meta has done to, quote unquote, streamline or get fit. And as we talked about yesterday, there are probably some problematic ideas circulating around the headquarters that have nothing to do with running a business successfully. But they're still extremely profitable, and they have like a lot of talent that's not Sundar. Ruth being a really great example, and she seems as though she wants to get more aggressive cutting. Look at what they started to do with the other bet stuff. Basically rein in the kindergarten that they have in an airplane hangar out there. So I think that there is a lot of opportunity for Google to right the ship.
Okay.
But I don't expect anything out of this stock right now. It looks like they're trying to turn themselves into like the Bud Light of technology. People are not going to revisit this stock anytime soon until they demonstrate that they're as serious as Zuckerberg was a year ago.
Do we expect anything out of another name that starts with an A in the Mag 7, which feels like it just hasn't gotten a lot of love, Jason Snipe, lately, and that's Apple?
Yeah.
6 months, the stock is no money. It's up 1.5%.
Yep.
Everything else in the space is up astronomically more than that, with the exception of Alphabet, when we talked about the well-documented issues and the most recent pullback in the stock, which was more dramatic than in a greater period of time. They have their shareholder meeting tomorrow. Yep. I don't know what's going to happen there. I don't know if it's a stock-moving event or not. We'll find out if anything gets announced. Doesn't usually fall in that category. But nonetheless, what's the issue here?
Yeah, no. I mean, listen, the stock is down 6% year to date, right? You know, I think for me, there's a couple of things. One, on the earnings report, China was a mess. China was down 13% and was not a good quarter in China. And we know what's happening over in China. You know, I think the AI play, again, Apple is not being identified or recognized as an AI player.
Yet.
But yet, to your point, Seth, yet. I don't know if they're going to talk about anything tomorrow. I think that comes later.
It's probably going to come in
I think that comes later in the year.
Summer.
But I think that eventually Apple will be, again, they're one of the most innovative players in the space. They will be rewarded, and they're going to do something.
Steph, you want to give me a quick thought before we take a break on Apple, because it's a relatively recent move for you to get into it.
Yeah, so I've been underweight forever. I still am, but I've been adding to it on weakness, down 10% from its highs. I thought the quarter was just fine. Nothing to get too excited about, but the guidance, we got it cut, got that out of the way. Impressively to me, with services is going to stay double-digit growth. April quarter, you likely get a new $90 billion buyback. WWDC is in June. You have a couple of catalysts. Everybody hates this thing now. I'm going the other way.
All right, guys, so to recap, apparently the Magnificent 7 is no more. It's going to be the Magnificent 4 or the Fancy 4, the Fantastic 4, whatever you want to call it. But apparently Apple, Google, and Tesla are no more. They didn't really say too much about Tesla, but they had plenty to say about Apple and Google. They said Apple has great prospects, but really needs to deliver on them. Apple's multiple is very high, and their growth is getting low. Tech is the 6th best sector over the last month, so the market rally is broadening. Investors are willing to take risk as the economy stabilizes. Google trades at a very slight premium to the market, so it's not very expensive at all. But Meta and Nvidia are definitely growing a lot faster. There are some concerns right now around Gemini, and there are some long-term concerns around search, but they will be the best to capitalize on AI when they get figured out. They're talking about Google. In the last 6 months, Apple is up 1.5%, Google is up 6.5%, Microsoft is up 26%, Amazon is up 30%, Meta is up 70%, and Nvidia is up 71%, guys. Those are massive numbers, massive, massive numbers. I hope you guys enjoyed the video. Just remember, just because these companies don't fit into an acronym doesn't mean anything changed with their business model. Hope you guys enjoyed the video. Catch you in the next one.